I am a research fellow at the University of Ottawa at the Open Air Research Hall. And today I'm going to be talking about AI credit scoring and financial inclusion. And I'll just start with financial inclusion, which is the access to affordable and fitting financial products and services delivered responsibly and sustainably to individuals and businesses. This is the definition given by the World Bank. And while the most popular component of financial inclusion is usually access to accounts, it also involves access to insurance, access to pension, as well as access to credit, which forms the large portion of my conversation today. In Nigeria, consumer credit is still quite low, and it's mostly sought through family and friend circles and through non-financial institutions. And the reason is because when banks provide credit, they usually require collateral or credit history from consumers. Of course, they do this to protect their business and to avoid non-performing loans. But what it means is that some people are excluded from credit facilities. And usually the banks would judge consumers on whether they have good credit or bad credit. And if they had good credit, which is the upper limit of about 700 to 850, they could get better interest rates, lower interest rates, higher loan thresholds, and they might not be asked to provide collateral. However, for consumers without a good credit score, they could have to provide collateral or get loans at higher interest rates. And the downside of this is that the data used by the banks may not present a full picture of a borrower. And for instance, if you're underbanked and you have no loan history or you have no credit card, it doesn't mean that you cannot demonstrate financial responsibility. And also the variables used by the bank are too few to understand the context of consumers. And so we've had some reforms by the Central Bank of Nigeria. The Central Bank has now adopted a risk management framework for credit, and it includes both guidelines, some acts, as well as the registration of credit bureau, some credit bureau. The Credit Reporting Act now allows reporting by consumers so that banks have a way of or a formal place of checking the credit worthiness of their consumers or of potential borrowers. And they can also share data among financial service providers can share data among themselves. Then we had the Secure Transactions in Movable Acts, which expanded collateral to movable assets so that people could use things like their jewelry, their devices, or even their farm produce to prove their credit worthiness. And these are registered within the National Collateral Registry. While these have been effective in improving the industry, we still find that sometimes the details within the registry is inaccurate or incomplete, and banks have to spend even more to do their due diligence checks. Also, they are updated monthly rather than on a real-time basis. So now enter alternate credit scoring. This is being deployed by FSPs, mostly by fintechs. And what they try to do is to offer consumers credit based on alternative data sources, such as their phone usage or their social media interactions. For instance, they could deem timely payments of utility bills to be an indication of financial discipline. And then your social media lifestyle should confirm that a consumer is genuine. Also, the advantages are in terms of streamlined processes, which are fast and automated, and AI predictability is able to add some nuances to consumer assessment, credit assessment. And then FSPs are able to offer personalized financial products to people. And this is especially beneficial to consumers deemed unscorable, because if you are an immigrant or you're a young person just joining the workforce, you might not have the credit history to prove that you're creditworthy in that formal sense that the banks require. Now, while these are also very interesting, there are some issues that alternative credit scoring could incur. For instance, I was able to find some data privacy, transparency, and bias concerns. In terms of data privacy, the vast collection and processing of data means that there could be a likelihood for breaches or misuse. And also, one wonders how consent for consumer consent is collected, especially when standard form contracts are used and there's no negotiation. Um, there are also issues around compliance, especially when um, providers share data. And then what is the ethics around using people's location or their social media networks to determine their credit worthiness? In terms of transparency, algorithm processing is very complex, and it's within, they call them opaque black boxes. So how do you really understand what goes on within the systems? How are they interpretable, and do they adhere to regulatory rules? This is especially important because consumers should be able to determine or to understand how their data is used for these assessments, and they should be able to adjust their financial behaviors to qualify more for loans if that is the case, and they should be able to opt out if they're not interested in the way their data is used, or even to seek redress if they feel like harm has been done to them. And then the methodologies of some of these companies are regarded as trade secrets. And so it's difficult for regulators to really see what goes on behind the scenes. And in terms of bias, there's just a variety of data that predisposes such data collection to errors and inconsistencies. And there could also be issues around discrimination where people's IP addresses or locations or even their income level are used to determine whether they qualify for credit. And if these kind of data are fed into the system, it could entrench further exclusion for people that already do not have access. And what it really does is there's a kind of social sorting whereby it makes them visible to the system, but it could exclude them from credit. And that could then become that could be the way that the system continues to see them. And so I feel like while we adopt some of these AI-based alternative data to make our credit ecosystem more inclusive, it's important to um, ensure that FSPs comply with data protection standards and that their systems are more transparent. Also, I feel like there should be humans in the loop to look out for bias. And there should be industry-wide collaboration so that FSPs can share data responsibly. And also, on a wider level, there should be support for financial inclusion initiatives that help consumers to improve their financial behaviors and just be able to qualify for loans when they need them. Thank you so much for listening.